Hello everyone. In this video, let us learn enterprise, business, growth, and size. Okay, let me tell you one thing. Now, this chapter number 3 of business study, which is very lengthy. I have divided the content in the two videos. This video contains half content, and the next video shall be posted later. So let us start. Entrepreneurship. An entrepreneur is a person who organizes, operates, and takes risk for a new business. The entrepreneur brings together the various factors of production to produce goods or services. Number one, they are risk taker, they are creative, they are optimistic, they are self-confident, they are innovative, independent, they are effective communicator, and they are really hard work. Now, let us learn what is a business plan. A business plan is a document containing the business objectives and important details about the operations, finance, and the owners of the new business. Some of the content of a regular business plan are as follows. Number one, executive summary. Brief summary of the key features of the business and the business plan. First info, the owner, educational background and what any previous experience in doing previously. The business, name and address of the business and detailed description of the product or services being produced and sold. How and where it will be produced, who is likely to buy, that means the target audiences, and in what quantities. The market, describe the market research that has been carried out, what it has revealed, and details of prospective customers and competitors. Advertising and the promotional activity, how the business will be advertised to potential customers and details of estimated cost of marketing. Premises and equipments of business, details of planning regulations, cost of premises, and the need for equipment and buildings. Business organization, whether the enterprise will take the form of sole trader, partnership, company, or cooperative. Cost, indication of the cost of producing the product or services, the prices it proposes to charge for the products. Finance, how much of the capital will come from savings, how much will come from borrowings. Cash flow, forecast income, that is revenue, and outgoings, that means all the business expenditure over the first year. So all these things should include in the business plan. Next, government support for business startups. According to the startup.com, a startup is a company typically in the large early stages of its development. This entrepreneur ventures are typically started by mostly between three founders who focuses on capitalizing upon a perceived market demand by developing a viable product, services, or any platform. Why do governments want to help new startups? They provide employment to a lot of business. They contribute to the growth of the economy. They can also, if they grow to be a successful, contribute to the exports of the country. Startups often introduce fresh ideas and technologies into a business and industries. How do governments support businesses? Number one, organize advice. Government provides all businesses advice to potential entrepreneur giving them information useful in starting a venture, including legal and bureaucratic ones. Number two, provide low-cost premises. Government provide land at low cost or a low rent for new firms, for mostly newly started business. Third, provide loans at low interest rate. Next, give grants for capital. Usually government provide financial aid to new firms for investment. Government give grants for training. They provide financial aid for workforce training. So basically, government provide a fund for investment, government provide fund for training. Give tax breaks or holidays. High taxes are disincentive for new firms to set up. Governments can thus withdraw or lower taxation for new firms for a certain period of time. How do you measure your business size? Number one, number of employees. Larger firms have a larger workforce employed. Value of output. Most of the larger firms are likely to produce more than the smaller ones. Value of capital employed. A larger firm are likely to employ much more capital than smaller ones. However, this method have their limitations and are not always accurate. Example, when using the number of employees method to compare a business size is not accurate as a capital intensive firm. One that employs a large amount of capital equipment can produce large output by employing very little labor workers. So basically the statement says that you cannot measure a size of business based on the number of employees. What if a firm is capital intensive and the other firm is a labor intensive? When it comes to the labor intensive, more of labors are there. When it comes to the capital intensive, more of machinery and the less of workers. Similarly, value of capital employed is not reliable measure when comparing a capital intensive firm with a labor intensive. Output value is also reliable because some different types of products are valued differently and the size of the firm doesn't depend on this. So basically, we have many options to compare two businesses, but none of the method is accurate because all the businesses differ from each other when it comes to the employment, when it comes to the equipment. Take an example of product, price, quality, each and every details of the business. Okay, let us learn business growth. How small business are going to grow in future? Businesses want to grow because growth helps reduces their average cost in the longer run, help develop increased market share, and help them produce and sell to them to new market. There are two ways in which business can grow. One internally and the second is external. Internal growth. This occurs when business expand its existing operation. For example, when a fast food chain opens a new branch in another country. This is slow means of growth, but easier to manage than external growth. External growth. This is when a business takes over or merges with another business. It is sometimes called integration as one firm is integrated into the other one. A takeover occurs when one business buys out the owners of another business, which then becomes a part of the predecessor business. A merger is when the owner of two businesses agree to join the firms together to make one business. External growth. It can be classified into three types. Number one, horizontal merger, or you can say horizontal integration. This is when one firm merges with or takes over another one in the same industry at the same stage of production. Remember this word, same stage of production, and the industry line should be the same. For example, when a firm that manufactures furniture merges with another firm that also manufactures furniture. Benefit number one, reduces number of competitors in the market, obviously, since two firms became one. Opportunities of economic of scales. Merging will allow the business to have a bigger share of the total market. Vertical merger. Second, or you can say vertical integration. This is when one firm merges with or take over another firm in the same industry but at a different stage of production. Therefore, vertical integration can be of two types: backward vertical integrations and the forward vertical integration. Since here stage of production is different, it can be backward vertical integration or forward vertical integration. Backward vertical integration, when one firm merges with or takes over another firm in the same industry but at the stage of production that is behind the predator firm. For example, when a firm that manufactures furniture merges with the firm that supplies wood for manufacturing industry. So one firm is just supplying wood to the manufacturing furniture, and the one who is actually manufacturing furniture. Forward vertical integration, when one firm merges with or takes over another firms in the same industry but at the same stage of production that is ahead of the predator firm. For example, when a firm that manufactures furniture merges with a furniture retail store. So here it's a forward vertical integration where one firm is a retail store and the one firm is manufacturing a furniture. Benefits: merger gives a sure outlet for the product. So for consumer, they have a variety. If they wish to go to the retail store, all the products are easily available, or if they want to customize their product, the manufacturer of furniture firm is also available. The profit margin of the retailer is now absorbed by the expanded. The retailer can be prevented from selling the goods to the competitor. Next is third one, conglomerate merger, or you can say conglomerate integration. This is when one firm merges with or takes over a firm in a completely different industry. This is also known as diversification. For example, when a firm that manufactures furniture merges with a firm that produces clothing, completely two industries are coming together. Benefit: conglomerate integrations allows a businesses to have activities in more than one country. This allows a firm to spread its risk. There could be a transfer of ideas between the two businesses, even though they are in different industries. This transfer of idea could help improve the quality and demand for the two products. Drawbacks of growth. We have learned all different types of growth, that is internal growth, external growth. Under the external growth, there are three different main growths. One is horizontal, vertical, and the conglomerate. Now let us learn disadvantages of growth. Difficult to control staff. As a business grows, the business organization in terms of department and the division will grow, along with the number of employees, making it harder to control, coordinate, and communicate with the people. Lack of funds. Since you are growing it, you need fund for each and everything. Growth requires a lot of capital. Lack of expertise. Growth is a long-term and difficult process that will require people with expertise in the field to manage and coordinate activities. Diseconomic of skills. This is the term used to describe how average cost of firm tends to increase as it grows beyond a point, reducing profitability. This is explored more deeply in a later section. All right. Stay tuned for part 2.